Good to see you. Good to be back. Ed Ponsi here, your FX educator here on behalf of FX Street. Once again, what a day. I'll tell you what, man. I'm here at the beach house. I'm actually sitting out on my deck. It just started pouring rain, but that's okay. I'm under the shelter here. And this town is very, very quiet today, the day after the 4th of July. And so we'll take a look. Now, for some folks, of course, it was a big holiday in the U.S. yesterday. And you may have seen the effect of that. For example, one of the things I mentioned earlier is that a lack of volume does not necessarily mean the same thing as a lack of volatility. This is a pretty big jump yesterday, about a 50-pip move within 15 minutes on cable, which has since reversed. Some speculation that this was a fat finger. I would say that's possible, but it's also entirely possible that it was simply an order that was placed in a thin market, and perhaps someone forgot that it was a holiday in the U.S. and you know, we could have hit the wrong button there, or maybe hit it a little bit too hard. But anyway, you can hear me okay? All right, good. Since then, you can see British pound hitting its lowest level post-Brexit, but it's really not about the pound. It's about a move away from risk assets and into the safety assets. Let's take a look. So, for example, pound dollar dropping to its lowest point post-Brexit. But if you look at Euro USD also pulling back a little bit. A lot of volatility here. You see this volatility this morning. A lot of that is based on the some numbers, some figures that came out this morning in Europe. We'll talk about those in a minute. But look at dollar yen in the same time frame that pound dollar is falling. Dollar yen is also falling. So the yen is doing very well here, getting very strong. And of course, when that happens, you begin to think, well, how long is it going to be until some sort of an intervention occurs? You know, yesterday actually would have been a perfect day to intervene with the markets being thin. One currency pair that you should be aware of, that there has been intervention recently, is the Swiss franc. And I'm going to pull up Euro Swiss, which I know it's a painful currency pair to look at for a lot of folks. But if you take a look, if you'll join me in taking a quick peek at this, there has been intervention in this, and it sure looks like there may even have been one this morning. Widespread reports of intervention from the Swiss franc, and apparently the highest degree of intervention since that disaster of January of 2015. The Swiss National Bank spent 6.3 billion francs last week, right? And apparently it looks like they might be in there again this week, but the dollar is strong in general right now. You see the euro jumping up against that Swissy. Right, so there could be an intervention. Right, so they've pushed it up to 108.50 on several occasions on these interventions. You can see it keeps coming up to 108.50. I just don't, I'll tell you, man, the Swiss, I just don't trust it. If I'm going to play the intervention game, I'm going to play it with Japan, who I feel is somewhat more predictable and less capricious when it comes to these sort of events. Okay. All right, so let's talk about also when we say it's risk. Risk assets also include oil. Look at oil getting body slammed here. Just getting pummeled. Right? Oil pulling back pretty sharply. Kind of an ugly situation there with the price of oil. I'm also going to talk to you about stocks this morning because stocks, the S&P 500 futures, well, what do you know? They look just like oil. And here we go again. We got above 2,100 on the S&P 500, and what happens? The same thing that happens every time we get above 2,100. We drop, and 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 we drop. And we're still dropping. Okay? And that's on the 15-minute chart. I can tell you what, this has been going on for a year and a half. Every time we get above that 2,100 level, you know, we just lose it. Here you go, on there, the danger zone, as we like to call it. So the S&P futures are falling away from that level once again. No big surprise, I suppose, at this point. All right, so, you know, what comes next? Well, it looks like the trends are pretty clear. Dollar strength, right, which you can see that we were in a downtrend on the dollar. And then we pop out. Okay? This is an awesome chart. From the beginning of the year, for the past 6 months, the U.S. dollar has been in a bear channel. Brexit forces the dollar out of the bear channel. And since then, we've been doing a slow fade. But that really looks to me, that's a flag pattern. Look at this. This is a classic version. What is it? What does it mean? What does it project? That's a bullish pattern, right? You have your flagpole, which goes approximately from 93 to 96. And then you have the flag itself, which is the pullback from 96 and change to about 95 and a half. The next move should be stronger dollar, according to this chart. TradingView charts give us info on pound dollar I can't get from my broker. All-time low for pound dollar is 112. Yeah, Carlo, you know, if you think about it, the pound has been around since, I don't know, centuries. Even the Bank of England has been there since the 1600s, right? So how far back would a pound dollar chart go? It would go back to the inception of the dollar. So would it go back to 1776? No, right? I'm sure Carlos knows this, but a little bit of trivia for you folks out there. The first currency in the U.S. was the Continental. It wasn't the dollar. And the Continental failed, as paper currencies often do, right? So I'm not sure how far back that pound dollar chart can go, but I imagine, you know, in theory, it could go back to the inception of the U.S. dollar. You know, but apparently there was a currency prior to the dollar called the Continental, and people used to use it for wallpaper. They started using it as decorations. Anyway, back to this chart. According to this chart, and listen, technical analysis is not perfect. To me, it's just the odds of one thing being slightly higher than another thing. So by no means is this a done deal, but I would say, based on this chart, there's a pretty good chance that we could see 98 on the dollar index. That would be a target. So, for example, how do we get 98? that would be a target, right? Make it blue. But in order for this to happen, the price has to break upward out of this flag, and we don't know if that's going to happen. In other words, first it has to get above 96 and break above this line. That line's a little bit subjective. Some people might cut through the wicks. You don't have to do that, but you can't get this without an upward thrust. It really does look like a flag there. Very patriotic that the dollar has formed a flag pattern on the 4th of July, right? So you measure the flagpole, 93 to 96, approximately. Doesn't have to be perfect, right? 93 to 96 is 3 points. Then I would measure from the low point of this flag, which right now looks like it's about 95.5. So if this were to turn and break upward, I would say 98.5 would be, the height of the flagpole is 3. So you add 3 to 95.5, you come up with 98.5. And then that would look pretty symmetrical, right? Rally, pull back, rally. This would also be considered an ABCD pattern. A, B, C, D. Which pair is the best to trade with the dollar? That's a great question. Normally, if you think the dollar something is going to happen with the dollar, normally the first thing I would look at is the euro. And there's a good reason for that. Like, we're looking at a chart of the U.S. dollar index, right? $ DXY, U.S. dollar index. And what's the biggest component of that index? Well, 56% of that index is the euro. Okay, so for that reason, the euro and the U.S. dollar are very often the antithesis of one another. I can demonstrate that using ETFs. So I'm going to insert euro into this picture. And so if I really think the dollar is going to go up, I probably think also that the euro is going to go down, because if you look at this chart, right, this is the dollar on top and the euro on the bottom. I'm using ETFs to represent the dollar on top and the euro on the bottom. The reason why I'm using ETFs is because TradeStation will not allow me to compare two instruments in the manner that I'm doing right now unless those two instruments have the same trading hours. And ETFs trade like stocks, so they trade like stocks. That means they start trading, at 9:30 New York time, and they stop trading at 4 p.m. New York time, and therefore I can compare them side by side. But I think you can really see that relationship here, that when one of these goes down, the other one goes up. So if I really think the dollar is going to go up, I probably think the euro is going to go down. Now, yeah, the pound might go lower, and pound is down a little bit, but does everybody understand that relationship before I move on from this chart? It's kind of a mind-blowing chart if you're not familiar with these type of relationships. Okay? Now, the reason why, let me tell you why, a second reason why I'd rather pick on the euro than the British pound. You realize that everyone thinks the pound is now going to go to nothing. But you also realize that a lot of what passes for analysis these days is political spin. There's a lot of political people who really don't like, the elites really don't like it when the little people rise up against them. And that's what you're seeing right now in the media. The people who, put a lot of money into the media are very unhappy, and so every story they print, it has to be negative about Brexit and negative about the pound. But really, the pound's been beaten down so hard The euro has not. The euro is still pretty much hanging in fairly close to where it was pre-Brexit, at least in comparison to pound dollar. Now, one of the things you might recall, think back to when Greece first became a huge issue in the U.S. In Europe. The Grexit, not Brexit, but Grexit, right? Grexit was a term long before Brexit was a term, right? Now, when they were talking about Grexit, everyone said that the euro was going to hit parity against the dollar, right? They all said, oh, the euro is going to go to parity, but it never did. In fact, every time that we heard calls for parity, right? Like here, it comes down from 160 to 120, and everybody's saying parity. What happens next? 150. It comes down to 120 again. Everybody's calling for parity. What happens next? 145. You get the picture, right? So they became overly negative, and these pundits, these people who make these projections, when they're all on one side, I don't trust it, because I know that half of these people couldn't trade 4 quarters for a dollar, and if they all think one thing, I almost can't think the same thing, right? So, and Joan, I do not disagree with that at all, but let's take a look. We'll come back to that, but I want you to know, so keeping in mind what happened when the world turned negative on the euro, they were wrong over and over again. The analysts were constantly wrong, right? Let me give you the year-end projections. We're now at the halfway point of the year. Here are the year-end projections for the British pound. As we look at the British pound chart, I'll take you monthly here. We're currently at 131, the lowest we've been since 1985. And yeah, we could go lower. But listen to the projections. Deutsche Bank. Deutsche Bank says cable will drop to 115. HSBC. HSBC says this will drop to 120. Royal Bank of Canada, 121. Rabobank, 123. ING, 125. Santander, 125. Morgan Stanley says between 125 and 130. JP Morgan, 130. Societe Generale, 126. Those are the projections by the major banks. Now, each and every one of those projections says it goes lower from here. Some say it goes as low as Deutsche Bank says it goes all the way down to 115. Have you seen Deutsche Bank's chart lately? If these guys were any good at making predictions, would their chart look like this of Deutsche Bank, right? Okay, how do you even stay in business, right? So, pretty nice head and shoulders to the top there, right? And it never recovers. Did you realize how bad Deutsche Bank's chart looks? Anyway, all these banks are predicting the same thing. They're all on the same side of the trade. They all think this thing goes lower, the pound. They might be right, but to me it sounds like groupthink. Like everyone's just decided this is the safe prediction to make. And, so I don't trust it. I'd rather think about the euro. And excellent point was made by Joan saying, look, what if somebody else decides to leave the Eurozone? What if Grexit is not the end? What if it's the beginning of the end? What if, I don't know, we've heard people say Frexit, France. I think that's highly unlikely, But there are certainly other countries that could make some noise, like Denmark, right? The Netherlands. I wonder if those countries are going to stay. So really the opportunity, the obvious opportunity is in the pound. Let's put it that way. The obvious opportunity is in the British pound. The less obvious opportunity is in the euro. So if the dollar index goes up from 95.5 to 98, I would imagine euro could certainly drop to 107. Does that seem reasonable? Or 108? I'm looking at this because I see the same pattern. Do you see what I see? This is a bear flag in the euro. So maybe the opportunity isn't necessarily shorting the pound, although that indeed could be an opportunity. I see a bull flag on the dollar, and I see a bear flag in the euro. And that goes from 114 to 110. So we come up, this is at 112, so 112 to 108. How do I get that? 114 to 110, approximately. That's 400 pips. Then we have, so we have the bears are very strong. The bulls mount a weak response, and as we measure the length, if it breaks under 111, then it breaks out of this pattern, and it goes a full 400 from here, 112 to 108. But first it has to break 111. If it breaks 111, I think it's going to 108. So there you go, right? You've got the dollar, U.S. dollar, flying that patriotic flag pattern, right? And the euro is flying the distress pattern, the upside down flag. All right, so there's that. Let us embrace deglobalization, says Carlos. I couldn't agree more. And there, you know what? With all the fear mongering that goes on in the press and the media, there's going to be a ton of opportunity here. You know, it's entirely possible that Great Britain could attract a lot of business that it wouldn't have attracted otherwise. So that's entirely possible too. And of course, you know, there's going to be negatives. They're going to have a couple of rough years, undoubtedly, right? But they could come out of it better. 5 years from now, they could come out way ahead. Just remember this. 50 years ago, Singapore literally got kicked out of Malaysia. No, Indonesia. Singapore got kicked out of Indonesia 50 years ago. Now Singapore's economy is bigger than Indonesia. Tiny little Singapore, right? So it depends on the attitude. It depends on what they do. Now that they've got some freedom, it depends what they do with it. Okay. When our stock market corrects, does euro go lower too? Probably, yeah, because a stock market correction would push. Again, this is most likely, and I couldn't tell you for certain, but the most likely scenario is that if stocks fall, people run to bonds, right? They want U.S. treasuries. So if they want U.S. treasuries, right, they need U.S. dollars to buy treasuries. There's the TLT. I'll put the 10-year. Here's the 10-year treasury. So they're already running the treasuries anyway. You know why? Because yields are negative in countries. So that tiny little yield on the U.S. dollar, on the U.S. Treasury, that tiny little yield actually looks really good compared to a negative rate. So there we are, right? So, but if the stock market corrects, that means I would guess that people would run to the U.S. Treasuries and push this even higher. But in order to do that, they're going to need dollars. You can't buy U.S. Treasuries with euros. You can't buy U.S. Treasuries with Japanese yen. You've got to have U.S. dollars. So I'm thinking the dollar would go higher if the stock market goes lower. And we saw from the chart when the dollar goes higher, there's a very strong tendency for the euro to go lower. So that's the way I think I see it shaking out. President Obama went to Great Britain to tell them that they were going to be in the back of the line because negotiations were going to take place with the bigger bloc. I suppose that changes now. Well, Carlos, that was actually the turning point for the leave camp. Was imagine how irritated you would be if the Prime Minister of Great Britain. Let's just say there was a huge major vote, and the Prime Minister of let's just presidential election coming up in a couple months, right? Let's say right 1 month before the presidential election, the Prime Minister of England comes to the U.S. and tells everyone who to vote for. That would really irritate some people. Well, our president went and told them how to vote in the UK, and that irritated a lot of people. And if that was the point where that was the turning point. I mean, when I spoke to you, the odds were 6-1. There was a 6-1 payout if you bet on leave, and that ended up being a pretty good bet. But the turning point was when our president Obama went over there and told them what to do and wagged his finger disapprovingly at them. That irritated a few folks. Tell you unintended consequences, right? Who knows, right? Well, you're not really the last line. So anyway, who knows? Interesting things happening in gold and silver, by the way. Let's not talk about that yet. Wait, what the heck? I got 3 minutes. I'll pull up a gold chart for you. Look at gold jumping, right? And there's your continuous contract on gold and your continuous on silver, which really jumped last week. So, but look at this on silver today. Jumps to 21, pulls back to 20, but this thing took off last week. Still like gold. There's a up there where gold takes off first, catches up very. It's because investors, I believe, look at silver and they look at gold leaving them behind and they say, I'm getting left behind here. Fear of missing out, right? FOMO, very strong emotional response. So due to fear of missing out, folks say, well, if gold's going up, silver should go up too. And it turns out that's true, especially if everybody believes it's true, right? Then it's self-reinforcing. So we saw a tremendous jump in silver. And then today it hit 21. So congratulations to anyone out there who held silver. Although it did pull back, it's still trading very close to 20. So congrats to anyone out there who's in the silver. Okay. All right. That's going to wrap up this segment. I really enjoyed speaking with you. Wonder if currency gets weaker, global weak. That's why I was here to ask, buy gold with paper money gets weaker. Paper is a funny thing. I mean, the dollar gets stronger, but only because it's measured against two currencies where Great Britain said quantitative easing last week. Europe said they were going to increase quantitative easing an hour later. That all happened on Thursday of last week. So, yeah, I would think, definitely pushing money toward gold and paper money. Also toward Bitcoin. Bitcoin's been kissing 700 recently, really kind of sprung to life through all of this. Okay, I'm out of here for now, but I will see you in about 25 minutes. So come back and join me in 25. I'm going to get a cup of coffee, and we'll pick it up where we left off, okay? My name is Ed Ponsi. Thank you for listening. See you back here very shortly.